Welcome to another video from Creativo Solutions. We're here to help you, and you're currently watching the Accounting for Non-Accountants video series. Please post comments and questions below, tell me what sections you're struggling with, and I'll make the video to help you. Please subscribe to this channel and visit the website for more content and resources. To continue our discussion around disclosure, we're specifically focusing on adjustments. Just to recap, how long is the financial reporting year? Well, we know the year is 12 months long. Do all transactions always relate to the financial year? The answer is no. So when we are going to present adjustments, we need to carefully consider what is actually happening in the transaction, because we need to report information for 12 months. And we're looking at the last 12 months that have occurred, because accountants are looking at information that has happened, data that has been collected. When processing adjustments, we need to make entirely sure that they are accurate and they meet the 12 months that we're looking at in terms of accuracy, because we need to look at the actual effects that they have on the accounting records of the books of the business. So remember, we're looking at rules. Rules are important. Understanding the accounting effects in line with the rules is the key to understanding and processing these adjustments correctly. To recap the rules, we've seen these rules a lot, and I'm stressing them because they're so important. Keep accounting simple for yourself. Apply the rules when you have different scenarios, and we do that by understanding where the pluses and minuses are. We know the rules are very specific. Asset has a plus on the debit, liability has a plus on the credit. Those are where they increase. Then we've got income and expenses. Income plus credit, expenses plus debit. Two other accounts that are easy to remember: capital starts with a C, credit starts with a C, and therefore the plus is on the credit side. Drawing starts with a D, debit starts with a D, and therefore the plus is on the debit side. Make sure you know the rules, and then we'll practice applying them. So we know transactions are recorded when they arise. So when looking at a financial statement, we're looking at 12 months. When looking at transactions, they can relate to the period, or they can relate to before or after the year end, depending on what we're actually looking at. Today, we're going to be discussing the accrued expense. Transactions need to be recorded when they arise. So if I have a transaction that relates to the financial year, I need to provide for it. If we incur an expense but only pay for it later, what are we going to do to the financial year? Well, remember, source documents are only received when a transaction occurs. So if a transaction has occurred, we'll only receive that source document later if it's something that we've incurred now but only pay for later. Simple example here could be something like water and electricity. Water and electricity needs to be billed first prior to that bill being sent to the actual consumer. So if I've used water and electricity during the month and it has not been paid, 1 month is considered to be outstanding. The bill will only come at the start of the next month, because that's when I actually know exactly how much I've used during the previous month. So if I'm looking at that 1 month in terms of the bill that's outstanding, it meets the definition of a liability. A liability arises today that will lead to an outflow of future economic benefit in the future. So when looking at that 1 month that's outstanding, we can't only show 11 months worth of water and electricity that we've used. We have to always look at the one additional month, because for 12 months you are using that specific expense. You've incurred it, you've used the water and the lights, the electricity, and therefore I need to provide for it in the 12 months. The transactions need to be recorded when they occur. So if I've incurred an expense, I'll record an expense. So the definition for an accrued expense is an incurred expense for the period not yet paid. If something hasn't been paid but you've incurred the expense, that meets the definition of a liability. So we're creating a liability to recognize part of an expense for the 12 months that have already taken place, because we're adjusting for all these transactions at the end of the year. Remember, financial statements are reporting for the last 12 months. So at year end, I provide for certain adjustments to make those accounting records more accurate. So the adjusting journal entry would be a debit for the expense and a credit for the accrued expense. The most important thing that we always need to remember is the why we do things. If we can understand the why, we can apply the rules in any situation. So let's discuss this now. If we think about the expense, the water lights bill, in the previous example we said 1 month is outstanding, it hasn't been paid. So are our expenses too high or too low for the financial year? Well, the answer is too low. So if I increase an expense, I'm going to have to debit the expense. Expenses increase on the debit side. Why do I credit the accrued expense? Well, that's according to the definition of a liability. A liability is being created. I know I've used something that I haven't paid for yet for the last 12 months. So that 1 month that we spoke about that hasn't been paid must be recognized as a liability, and therefore I will credit that accrued expense. That takes us to the end of this video. Thank you for watching. Please subscribe to the channel and please post a comment below telling me if you understand what an accrued expense is.